Wall Street has urged the central bank not to raise interest rates, at least temporarily, while the whole fiasco is going on with Silicon Valley Bank and Signature Bank. But as you can see, the Federal Reserve decided today to raise interest rates anyway, despite the banking system collapsing and having a very big code red issue. This isn't looking good, and in my opinion, this could cause a domino effect and a ripple effect in the economy. So now what? What are we actually going to do with portfolios, investments, and how can you make money? Or better yet, how can you preserve your money? Because as we can see in the market, it has gone down after hours. Recession fears are rising, and as you can see right here, I am looking at the VIX. The VIX is a fear gauge for Wall Street. So the higher the VIX goes, the more fear there is in the market. And specifically, VIX is looking at implied volatility, and that is going to be into the future. So VIX is tracking the next 30 days, what investors are expecting for implied volatility. And as you can see here, we were actually very low for a very long time. And so far, 2023 has been a very easy time for investors. A lot of investors have made good money and steady returns. In fact, in my portfolio this year so far, if you look at my year-to-date returns, they're very stable. I have made 6.25% return, and it's basically just an upchart that is very steady. However, as you can see now, there is a big change in the VIX indicator. So the VIX was very low since the start of the year. Basically, it was actually starting the year at above 20, but for most of this year so far, it has been below 20. And as of recently, the VIX has spiked up and is basically probably going to continue to go up, in my opinion, because as interest rates go up, as inflation goes up, both of these things are very dangerous for the stability of the economy, and specifically, it is scaring investors. And again, the more fear there is, the more volatility we're probably going to see, which is a good and bad thing, which I'm going to explain on how you can take advantage and protect yourself in these times right now. Because these times are pretty easy so far. The first 3 months of the year were just cake. And now I think this is going to be the time where good investors and bad investors will be differentiated, okay? Because when the market goes down, if you're not hedged, if you're not in the proper positions and hedging your portfolio essentially, then you're going to just experience a loss just like everyone else will. If you're not holding index funds, you're probably going to experience a bigger loss because most stocks have a higher beta than the index funds, right? SPY, Triple Q, the NASDAQ 100, right? For example, if you have a lot of single stocks, you may be in more danger right now than if you're just holding index funds. But that is okay because there is a lot that you can do, specifically covered calls being one example. Now, as I look at the VIX right here, it has gone down, basically saying the market might calm down, but I don't think so. I think what's going to happen in the market for the next probably few months is we're probably going to be above a 20 VIX, and that's going to mean that stocks will be bouncing up and down. Now, to be completely honest, I have no idea which way the market's gonna go. I think that anyone says that they do know is a complete liar or a scammer, because even Warren Buffett doesn't know, billionaires don't know. I certainly don't know, but I do know that if you hedge and have high quality cash flow stocks, safe, consistent cash flow, then you can actually come out up top even in these tougher times. And I was reading that policymakers aren't expecting a recession, which to me confirms that there's going to be a potential recession, because when Wall Street says something's not going to happen, it is kind of safe bet to just do the opposite. As you can see here, that the Fed funds rate is basically as high as it's been since about 2007, 2008. And we haven't seen interest rates this high. And this is causing a ripple effect in the market because this is causing interest rates to go up, which is making it very expensive for people and folks trying to buy a house. For example, US sales of existing homes jumped 14.5% in the prior month, but as of February, it was actually down. It was down year over year. And that was the first time in 11 years that the market, the housing market to be specific, is down. Now, the first time in 11 years, that is sounding very similar to a potential recession. So the national median existing home price fell 0.2% in February from a year earlier to $363,000. Now, that's actually an amazing price. If you look in bigger cities like Miami, LA, and New York, the prices are completely outrageous and more than double these prices for a reasonable house. And sure, I think the biggest cities in the US could be okay because there are people making significant amounts of money online right now, but the majority of US still has 9-to-5 jobs, and the majority of people aren't able to make the 1% income because that's just by definition. There are some people that are moving to big cities, but for the majority of people, it is going to be much more hard to buy a house. So check it out. I have a mortgage calculator right here just to show you how much more expensive a 1% interest rate change can be for a home buyer. So I'm looking at a home value right now of $400,000. Let's say that you put down a deposit of $80,000, which is 20%. You have a loan amount of $320,000. If the interest rate is 5.7%, you're basically going to be paying a total monthly income of about $2,100, right? It depends on the city, the state, because there are other expenses involved, such as property taxes and other expenses. But for example, let's say that 5.7% now goes up to 6.5%, which is pretty much where the interest rates are right now. And if I click calculate, it goes from $2,100 to $2,300. That might not seem like a big deal, but that $200 difference is actually a pretty big amount, especially for some people's take-home pay. So if you're making $6,000 a month in big cities, you're probably taking home about $4,000 after taxes. And a $200 increase within your budget is actually 5% of what you make per month in your take-home pay. So just a 1% interest rate difference is actually a very big amount. And actually, we were looking at 5.7%. If I do 6.7%, just a 0.2 increase, which is basically what the Fed Reserve just increased things by. So if I go to calculate, it's slightly higher, $2,348. So with this rippling effect, what I think is going to happen is that construction is going to slow down, because construction isn't going to be as needed if people aren't buying as many houses and they're forced into delaying a potential home purchase. But there's an even bigger issue. When there is a construction slowdown, construction actually fuels our entire economy. The housing market is such a huge part of our economy. I mean, seriously, there is people that are in the labor market. There are companies like Home Depot, Lowe's. There is tens of billions of dollars at stake here. And when there's a slowdown in construction, there's a slowdown in labor. And when there's a slowdown in labor, there is a slowdown in just general consumption in the United States, right? Because people are making less money. Therefore, they're going to be spending less money as well. Also, if you think about it, the banking sector and all of the financial sector, to be honest, does rely heavily on mortgages, because when people take out mortgages, they are paying a lot more over the life of the mortgage. For example, they may end up borrowing about $400,000, as we can see here, but if they end up paying $2,348 over 30 years, that amount is going to be actually $423,000. And the total amount that they're going to pay is going to be $845,000. So that is a significant amount of money that is being created essentially out of thin air. That's how finance works. You charge interest, and then your money grows and it compounds. And banks are no strangers on how to make this money. That is why New York City is so wealthy. They have the financial sector down packed. They're basically able to print money out of thin air through mortgages, and that is a very huge part of the economy. So my suggestion is to be underweight financials. If you have a lot of financials in your portfolio, that is not a smart idea, because banks, even JP Morgan, Goldman Sachs, Bank of America, these big banking companies are likely not to perform so well, despite them actually performing well usually when interest rates go up. Because typically what happens is banks are able to raise their interest rates and pass that along to the consumer, and the consumer can't really do anything. They just take the prices as is. So when the Federal Reserve raises interest rates, banks follow along, and they do actually make more profits usually. But this time, I do believe it's different, and I do see that banks are suffering. Silicon Valley Bank, right? Big issue. Signature Bank. And I think there is many, many more to come, and it's called interest rate risk. So when interest rates go up significantly, banks are not necessarily immune. Some banks have a huge problem on their balance sheet, and they can go bust, as we can see right now. So we're underweight financials. I really don't have any financials in my portfolio at all. Actually, if we take a look at my portfolio, I only have American Express, which I sold a very short-term put option on, and so far I'm up $46, about 83% on my option that I sold, which is a very easy strategy, because my strategy is essentially selling out of the money options and collecting pretty consistent income. So as you can see here, despite the market actually not doing that well, if I actually go to my performance today, I am down 0.82%. 0.82. In the market, if I look at SPY, is down 1.52%. So I am doing pretty much double, or essentially half of the loss of the market. And I am losing a lot less because I'm using hedging strategies. So for me, it's covered calls. It's selling puts out of the money, right? When I sell a put out of the money, even if the market goes down 2, 3, 4%, my puts are usually 5% out of the money. So even in a specific week, if the market pulls back, I will still end up making about 1%, sometimes 2% on my money when I'm selling put options, and of course, a lot more money when I'm doing spreads. The types of companies that I would be in right now is going to be energy, utilities, and consumer staples. These three are specifically something that I'm looking into and probably going to put more money into because these types of sectors fare better when there's a lot of volatility in the market. For example, utilities. People are still going to have to pay their electric and their gas bill, right? So these utility companies are going to do just fine. Same thing with energy. When people have to go to work, people have to travel, these energy companies are going to still make money off of gasoline, petroleum, etc. So gas, utilities, and lastly, consumer staples. So consumer staples are going to be your companies like Procter & Gamble, companies that are providing toilet paper, toothpaste, essentials for human healthcare, right? So for example, Johnson & Johnson is human healthcare. So they sell a lot of different products like Listerine. All of these products are still going to be bought. And in fact, these companies can raise prices without people really, again, doing much about these prices. So if toilet paper goes from $3.99 to $4.99, people are still going to be buying toilet paper, right? And if the toothpaste goes up from $3 to $3.50, people are still going to be brushing their teeth. Now, what I want to also point out is in my portfolio, I do have some China exposure. And I specifically think that China is actually an interesting play right now. Despite China having their own separate issues and lots of volatility, lots of uncertainty, the China yuan, their currency, is not pegged to the US dollar. So if we are having some issues domestically, it's actually not that bad of an idea to invest in Chinese companies. Now, there is a popular ETF that I like to look at, which is KWEB, which is the China Internet ETF. I have been following this for some time. I haven't really invested any money personally into this, but over the past year, it has not done that well. Now, that doesn't necessarily mean that past performance is future returns. In fact, that's pretty much the biggest myth, the biggest fallacy within investing. People will see good past returns and they think that means good future returns. And I know that of myself, and that's why I operate my trading and my investing as if it's day one, basically as if it's Jeff Bezos, right? Jeff Bezos is always afraid that Amazon is going to fail, and he's in fact famous for saying that Amazon will fail one day for sure. And I operate my trading career essentially the same. I'm always looking at my portfolio, thinking, how can I make consistent income? Because if I can make consistent income and live on that, that's great. But I'm also always trading in a way to not lose money. Diversification, risk management is literally the most important thing, because even a monkey can go out there and pick stocks, make some money, right? If you throw a dart at a bunch of stocks and you just pick stocks at random, you actually will perform. I know this is crazy, but you'll actually perform better than much of Wall Street. That's actually proven. By randomly picking stocks, you can actually do much better than a mutual fund manager. I forget the statistic because it's been a few years since I took that class in college, but when I was learning about fund manager performance, it was completely abysmal. Like, their performance is so bad, it makes more sense to just have a monkey pick stocks at random than having a professional money manager. And another statistic is actually teachers outperform Wall Street professionals because they take less action. So when you actually take less action, I know it's completely counterintuitive, but when you do less in your portfolio, you get better returns, because the worst thing that you can do is get emotional, try to time the market, and that's when your mistakes come. When you try to time the market, essentially, get out of a stock as it's falling, sell a stock as it's going up, actually it's proven that you should be doing the opposite. So whenever you see stocks selling off and you have that urge, you're just like, I can't take it anymore, I need to sell this thing, I'm done, I'm out of here. Well, that's actually the perfect psychological time to not sell. And then when you see a stock going up and you're like, I'm making all this money, tomorrow's gonna be up again, I'm gonna keep making money, that's actually the optimal time to sell. So I know it's not logical, but the market's not supposed to make sense. When I was working at Goldman Sachs, someone basically told me that the market's job is to confuse the most amount of people. So basically, don't be confused. I'm here. Subscribe to this channel. I'm going to keep you informed. But for me, being in China is very, very interesting right now. So although this has not had the best performance, I would look at what is inside here. So, we have Tencent, we have Alibaba, which I have Alibaba in my portfolio. And there's a lot more. There's Baidu, there's NetEase, there's JD.com, and even Trip.com. So for me, though, I am looking at two China companies, okay? Number one is Alibaba. So Alibaba, for me, I have an 87 covered call, which I have made $540 on. I have a 79 put that I have sold. It's slightly down at $20, but that's okay. I have another 80 put, which I'm up $555 on. All of these trades, by the way, I'm posting in Discord. You can always check out the first link in the description for my Discord. And yeah, as I go into my shares right here, you can see that I currently have 1,000 Alibaba shares. And today, if I go to the one-day return, they're not even down. I mean, they're down 0.07%, which is basically nothing. And then after hours, they're up more than they're down. So essentially, having some China exposure has actually saved me a lot of money. It has saved me money because the market is down today. And Alibaba actually gave me a lot of support within my portfolio. So for example, if the market were to crash 20% and I had 100% of my money in the US market, I would lose 20% of my money, right? But if I have 50% of my money, now this would be too much. This would be an exaggeration. You should not have 50% of your money in China, clearly. But just as an example, if I have 50% of my money in the US stocks and then 50% in China, and China stands still, but the US market falls 20%, I'm going to fall 10%, which is actually a relatively huge win. I have won by 10%. And that's why I like China right now, because if the market and more banks end up, going out of business essentially, and houses end up going for foreclosure, people can't afford their mortgages, construction industry goes underwater, whatever, right? If the worst case scenario happens, which I'm not expecting that to happen, right? I'm not a huge bear on Wall Street, right? I'm not. I'm just a regular guy. I'm an investor, and I think that the market is fairly neutral. That is my perspective. I know there's a lot of bulls out there, there's a lot of bears out there. I'm usually fairly neutral. I want to make consistent cash flow. I want to make consistent passive income, 1 to 2% a week. For me, that is a huge, massive win. I would be very happy with those type of results. And that's basically what I've been after for a very long time. I just want my consistent income so I can fund my lifestyle. So for me, if I can have some diversification and not suffer big losses, again, who knows? Maybe we have a recession, maybe we have a crash. Then I want to be in stocks like Alibaba. So I have 1,000 shares of Alibaba. I am slightly up by $780 on Alibaba. And actually on my options, I'm also up about $1,075. So as you can see here, options are not really risky. The way I trade them, I'm trading them for income, and I can make money on the stock and on the options at the very same time. Now, I have actually meant to trade NEO today. I didn't get a chance to, but NEO is another stock that I want to sell put options on. And if I look at my history, again, full transparency, I share everything on this channel, nothing to hide. I have been selling $8 puts, $9 puts, $10.50 puts. All of these have actually been successful. This expired on Friday, so I am due to make more NEO trades, and I'm most likely going to trade around the $8 strike. So currently, NEO is down 2%, so NEO did experience a loss, unlike BABA, which did not really experience that much of a loss today. In fact, it was flat. So these two stocks can add a lot of support and safety to your portfolio. I know it's funny saying that because it's a Chinese company, but the more diversified you are, the more sectors you're in, the better, and I would avoid the financial sector. I would keep a very close eye on what the Federal Reserve is doing and what is happening with the banking sector right now. With that being said, invest safe right now, and I'll see you in the next video.